Hello and welcome to episode 391 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leakes. Damien, we're back in the office in the same place and we've both got a voice.
We've both got a voice. I actually think I could be potentially going to lose mine again, all because of those infusions I have for my Crohn's disease. Every time I have one, I tend to get sick just after or get a cold. So let's hope that it holds up. But on that note, it was really good last week to do the live event that I did. We've been talking about the live event, and obviously I didn't cover it on the podcast last week because it was pre-recorded, but I went to the event in London and I did meet a number of you. And the reason I link that is because the week before I went to the show, I was just fretting about trying not to get some sort of cold, because there's nothing worse than doing a live event when you feel dreadful. So it was fab to meet a whole load of you at the event. I have to mention John and Stephen, two friends actually, who both are listeners to the podcast, and I did enjoy their company. And Andy, they were begging along with other people for us to do a meetup for the podcast, so a proper meetup in a pub somewhere. So we're working on that in the background, and we'll give you more details in the future, because it would be nice to do it. And also a lot of people were asking about the team and wanting to meet them. And of course, one of them was a Watford fan, Andy. So there is more than one Watford fan in London. So we've got to do that meetup. But it was really good to chat and do that live event about pensions and the cost of living crisis. So it's going to inspire a piece on the podcast this week, because I'm going to take some of the questions that I was asked on stage and in the intervals and give you the insights that I delivered at that event.
Okay, so what else is coming up on the podcast?
The other thing I'm going to do a piece on investing and the correlation between assets. We touched upon this subject earlier in the year. In episode 366, we talked about the death of the equity bond portfolio. Well, we're at the end of the year now, and things have continued to be very tricky. So I want to revisit that based on a piece of 80/20 research. And the final piece on the show is going to be about cutting your food bill. Now, there is an app we've mentioned on a past show that has become somewhat of an obsession in my household. So we're going to be talking about that, and there's going to be a special guest on that part of the show, which you will want to listen to. So before we jump onto that though, Andy, two other bits of admin I just want to mention. Damien's Market Update will be out next week. So don't forget, that's my monthly show where I talk about investing and what's going on. So make sure you catch up with that. And a big piece of news this week was the Bank of England increasing the base rate to 3% from 2.25%. And of course, lots of people wonder, what's that going to do to their mortgage payments? Well, the great news is we've just launched a calculator at Money to the Masses, which will in seconds tell you the potential change to your mortgage repayments as a result of an increase in the Bank of England base rate. But you can use that calculator to also see how much you'll pay on any given mortgage rate. And it is useful even for those people, not just on trackers and variable rate mortgages, but those on fixed rate mortgages who could be coming off of that fixed rate in the next year, for example, and maybe trying to work out what their payments are likely to be in the future. So we'll put a link in the show notes and on the article on the website that relates to this particular episode. But just to read out the URL now, it's moneytothemasses.com/mortgage-home/mortgage-repayment-calculator. But if you search mortgage repayment calculator on the search bar on the site, you'll also find it. So that's the admin out of the way.
Great. So what are we going to start with this week?
Let's start with the investment piece. So as I mentioned, episode 366, we did the death of the equity bond portfolio. That was the headline. And I looked at the time, this was at the end of April. So markets at that point were falling quite heavily, and bonds and equities were both struggling. And of course, it was early on in the year, and it was a new environment that we were in, where we were seeing this positive correlation between bonds and equities, which is unusual. And that means that they were moving in tandem. In this case, they were both falling at the same time. And I did a piece of research for 80/20 Investor to look at how could we potentially invest in an environment like this. But the problem was that there was very little information or data, because it was so early on in the year, to be able to look at correlations between assets. A correlation is a statistical measure of how assets move in relation to each other. And so the way I tackled that problem at the time was to look at some of the all-weather portfolios that exist out there that I've analysed in the past on this show and on 80/20 Investor, looked at which ones had performed the best up to that point, that was the end of April, and then drew some conclusions from that. And at the time, commodities, gold, cash, targeted absolute return funds were doing quite well. bonds were struggling. And the message also at that point was to diversify into those assets away from just a simple equity bond portfolio, but also to reduce that equity exposure. Now, what I've done is we are in November. I don't know where 2022 has gone, but with all this data that we've got for the year to date, I could then analyze how different asset classes have performed in this environment. And the environment has stayed the same because obviously back in May, we didn't know things were going to change. And don't forget, correlations between assets do change over time and they can revert back to where they were before. Bonds and equities have in recent history been negatively correlated, which means they move in opposite directions. So when one goes up, the other goes down and vice versa, which makes them good diversifiers in portfolios. But of course, 2022, that all changed. We didn't know if that was going to continue. We now know, looking back to the start of 2022, things have just gone from bad to worse in that regard. And an equity bond portfolio is down over 12% if you have a 60% equity portfolio, 40% bond. And so given what we know about 2022, I went back and not only looked at how those all-weather portfolios have done, but I more importantly created heat maps that were looking at the correlation between different asset classes. Now, if you want to go and look at these heat maps, and they're incredibly useful, then you can take out a free trial of 80/20 Investor. Obviously, I can't show you those heat maps for free. I can't even do it on a podcast, obviously, but I can give you some of the insights that came from that. But you can find the heat maps on 80/20 Investor, and they help you to build a portfolio in the current environment, assuming that this trend continues, the correlations that we've now seen, because things have changed significantly in 2022. Now, in the heat maps, I covered 25 domestic and international investment association sectors. So that includes everything from bonds to gilts to global bonds to emerging market bonds to all types of equities. So from different geographies, be it UK smaller companies, North America, Asia, and compared how each of them had moved in relation to the other. And you work out correlation using something called a correlation coefficient that ranges from -1 to 1. -1 means something is perfectly negatively correlated, so they move in opposite directions. 0 means there's no correlation, so they just basically ignore each other. And then a coefficient of 1 means they move in tandem, so they move in the same direction, almost holding hands. Now, if you build a portfolio, you want things that are going to move in opposite directions or in isolation to each other. Now, to be able to see the change in correlation, I did a heat map that covered the 3 years before 2022, so that's 2018 to 2021. I did a heat map for how these assets performed and moved in relation to each other for 2022. And then I made a heat map to show the change in that, so you could see which ones had either become more correlated or less correlated. And there were significant changes. So to give you some of the high level findings, what we found is technology stocks have become increasingly correlated to UK gilts, which does make sense because they are both affected by interest rate risk. So when interest rates rise, it obviously is a negative for fixed income because obviously the fixed income payments on those gilts become less attractive. And as for technology stocks, because their earnings are often way off in the future, when you discount them back, if the rate that you discount them back is higher, then that makes the current share price lower. That's just a fundamental of investing. So what was interesting is UK gilts were really the own goal of 2022 because they had historically, before that, been uncorrelated to almost every asset class. That means not even negatively or positively, they were uncorrelated. So they were really useful, and actually they started to appear in a lot of those all-weather portfolios and my own perfect portfolio that I built on 80/20 Investor. But what's happened in 2022, not only have they underperformed in line with other types of bond and global government debt, but because of the mini budget and that complete car crash, they really slumped. So any exposure to UK gilts has been bad, and they've become now positively, highly positively correlated, in fact, to almost every equity class out there. So therefore, you've increased the risk of your portfolio if you hold them. Now, this is a very unusual year. In fact, the performance of bonds and equities and the way they've fallen together is a 1 in 100 year style event. So if you think about it, this is like the news stories where you see those record floods that occur. That's what we're seeing in the investment market. So what I'm really telling you here is how do you get to high ground to try and limit some of that damage? The other thing that we found is that Yes, global bonds and equities have become increasingly correlated as we've gone through 2022, but cash really remains the most uncorrelated asset out there because it does its own thing. And gold has also proved a good diversifier. It doesn't mean that it's necessarily always made money, because in the last few months we have seen a fall. But for UK investors, they've sometimes got a nice bonus from the fall in the pound to dollar exchange rates. You've been given a bit of a kicker there. Now, one of the sectors where correlations to other assets has remained relatively unchanged has been the targeted absolute return sector. But if you look at it, because while doing this whole piece of research, you don't want to just focus on correlations, because something can be uncorrelated because it's a complete disaster of its own. So targeted absolute return funds have really given you pretty dismal returns over years prior to 2022. Now, in 2022, the returns have been positive, certainly for some of the funds in that sector, or they've been less severely impacted to the downside. Now, that's a relative basis, so it doesn't mean it's been wonderful. It just means it's been less bad. So for once, targeted absolute return funds seem to be doing something very different. That's because bonds and equities have crashed. In past years, it has been the case that bonds were probably the better diversifier. Now, commodities, as we've gone through the year, have consistently been a good diversifier throughout, but they also were prior to this. So 2018 to 2022, they have been a good diversifier, but they've become less correlated to other asset classes this year. And that's because partly of the war in Ukraine, and we've seen surging energy prices. And don't forget, commodities can include things like energy shares in that particular sector. And the other thing we noticed is that global bonds have really gone nowhere in terms of performance in the last 3 years prior to 2022, and they've lost money heavily this year. So looking at it overall, the message is that in an environment like this now, where we're seeing rising inflation, questions over growth, but rates going higher, then it is still cash that is a good diversifier. Gold has managed to produce a positive return, and commodities as well, and that targeted absolute return sector. And it's the combination of those that you would really need. Now, you could use the heat maps to go along and look at the different correlations. But as I mentioned earlier, one thing to look at as well is that Chinese equities pretty much are doing their own thing. They're negatively correlated to everything, but that's partly because when markets were flying, say in the years prior to 2022, Chinese equities could be doing anything and could be crashing. So just picking things that aren't moving in the same direction can absolutely hammer a portfolio, because you could just be thinking, well, this is completely uncorrelated, but it's fallen 30%, which completely undermines maybe the 5% you've got in the other stuff in your portfolio. So looking at the performance as well of these sectors, if you looked at the uncorrelated ones, you might pick Chinese equities, but that's been a car crash, down nearly 29% year to date. But the real highlights, if you were going to pick sectors that showed a lack of correlation, is gold, that's up around about 8% year to date, commodities up at nearly 14%. But if you're looking at equity sectors, then global equity income has been one of the best sectors in terms of relative performance. Yes, it's still down, but it's not down as heavily as a more wider equity fund. And that's because equity income funds will invest in particular types of companies, and they are usually the good dividend payers. They might be some consumer staples, or they may be energy companies. Another good equity sector has been the North America sector, because again, that kicker you're getting from the fall in the pound has helped in 2022. And I've just done some technical analysis for 80/20 investor members as well, which I will talk about some bits of that on next week's market update. But 2022 has been characterized by the pound tumbling. It doesn't seem to be a lot that's going to stand in its way at the moment. So if that continues, that's fed into a lot of what we've seen as well. But if you were going to stick to the UK, then again, it's UK equity income funds that are the standout, those that rely on decent dividend payers. And even though that's down 10%, that's way better than the 16-17% fall from the wider all company sector. So there you go. Focus on correlations if you can, but also bear in mind performance. And until the correlations revert back to those of conventional wisdoms, then we are still in a different world. And if you'd listened to that podcast back in May and you'd applied some of the learnings you had there, then you would have ended up with a portfolio that looked like my 50k portfolio in 80/20 Investor. Now, year to date, I'm down 5.9%, which I'm pretty pleased about, given that the average 60-40 equity portfolio is down 11.5%, and the average professionally managed fund that's out there, that is down over 11% as well. But it's really important in investing to try and minimize drawdowns, because then don't forget, if you lose 50%, you've got to make 100% to get back to where you were before. So drawdowns, minimizing them is important. So there you go, Andy. Some lessons from 2022 for people that they can try and apply to their portfolio. It means looking at sectors you might not have looked at before, which includes commodities, targeted absolute returns, and of course, cash. And we've talked about interest rates rising. You can get some pretty good rates on cash at the moment. You can get 5% without trying too hard.
A quick question. You said earlier on in the pod that this is those record floods, the 1 in 100 years event that we're experiencing now, with a positive correlation between equities and bonds. And you mentioned there at the end of the podcast that conventional wisdoms with the way that equities and bonds usually work. Will we see a reversion back to that? And if so, I know you haven't got a crystal ball, when might that be? Or is this the new norm?
So that's a good question, because if you go back to that previous podcast, I talked about a bit of research that Schroders did that showed that we do get periods, and it can be extended periods, where that change in correlation, particularly between equity and bonds, can go on for an extended period of time, not just months. It can go on for years. And it happened previously where we went for an extended period of time between the late 60s and early 2000s, where there was a positive correlation between the two. So it can happen, with just that we've been used to for the last basically 20 years, there being a negative correlation. So yes, it could change. We are in a 1 in 100 year event. So the chances are, I've got no crystal ball, but mean reversion is likely, and some of these correlations could revert back. But that's why you don't chuck the baby out with the bathwater. And I still invest in equities. My portfolio for 80/20 investor has 60% exposure to equities. It's about which equities you pick. And the other 40% does have some exposure to bonds, but not very much. It's the other asset classes as well. So that's what portfolio construction is about. You can still have exposure to various different assets and still have risk, but what you're doing is trying to manage it. So when you get those drawdowns, you have assets that move in different ways. So it's a good question. I don't know when it's going to happen, but in the FT this week, Vanguard did an article. They're obviously worried enough about the impact on life strategy funds, and they're getting some bad press about it and some unhappy customers. And they were highlighting, again, this fact that this was an unusual circumstance. And they've actually looked at the makeup of those funds and have decided, do you know what? We're not going to do anything different, because they believe there will be a return back to that historical correlation.
Basically, you made hay while the sun shone, and now you're having to suck it up.
Yeah, but that is the reality of investing. It's a bit like if you're going to surf and you're going to ride those ups and downs. You can't complain if you get wet once in a while. You just have to get back on that surfboard. But that links very nicely to the next section we're going to do about pensions, because I got asked a very similar question at that live event.
Okay, well, unintentional segue. Let's go straight into that then. So you're part of a brilliant panel at the live event with Pension Beat, and you're asked a particular question, and I know you love an analogy. An analogy popped up in there, and you're going to explain it.
So yeah, on this one, it was a link between the cost of living crisis and pensions, which does seem like getting two things and really ramming them together. But I can understand there is a connection, because there will be people out there wondering about whether they should cancel their pension contributions. And there'll be lots of listeners who are thinking, yeah, I'm going to dial down my pension contributions. I'm worried about the future. Now, I was asked the question, should people stop contributing to their pension? And of course, I'm at an event that is a pension company, and I think there's other pension companies out there that have been doing events, and you've got to realise that they need your money to make a profit. So I'm independent, and my view on a lot of things is that, yes, if you're building a reservoir over here and your house is on fire, well, there's no good filling the reservoir with water and letting your house burn down. That's the immediacy of the problems that people are facing, the cost of living crisis. Now, people shouldn't just turn off their pension contributions. Yes, if you really can't afford to feed your family, that's an obvious decision. You've got to go with the immediate need. But what I describe the situation is rather than an on-off switch, think of it like a dimmer switch. So you've got a light switch in your house, I've got one, in a dimmer, and you turn it down and the lights dim down, but it gets to a point where it stops and the lights remain on. That's the lowest setting. That in the pension world is auto-enrollment. So most people will be enrolled via a pension at work, assuming you're employed. If you're self-employed, there isn't an auto-enrollment scheme. But the reason why I talk about a dimmer switch, because that minimum contribution will be, say, your 5%, which will be matched by the 3% from your employer. And some people will have higher matched rates from their employer. If you stop contributing to your workplace pension, then you will effectively opt out of auto-enrollment and you will leave that free money on the table from your employer. You won't receive any of that. So if you can, don't cancel pension contributions. At least dial it down to that point where you're still getting that free money. That's for the future, because you want to invest for the future to be able to improve your situation. So that's the dimmer switch analogy that I had. Of course, if people aren't in auto-enrollment, they might be self-employed, or they may be putting money over and above what's under auto-enrollment. So they might have their own pension that they're putting money into as well. Then, of course, you can dial those down. But there are alternatives, because don't forget, if you're worried about not having access to your money in a pension once it goes in, there is nothing to stop you putting money in an ISA, so a stocks and shares ISA, and investing in exactly the same way. In fact, if you are with a platform, you can invest in exactly the same funds. You won't get the tax relief on the way in because it's a stocks and shares ISA, but in the future, assuming you've got sufficient earnings, you could theoretically take that money out of that stocks and shares ISA if you really wanted to put it in a pension, because yes, pensions are the most efficient way to save for retirement. You could take it out of there and then put it in as a pension contribution in the future, assuming you've got enough earnings to allow for that. But all that time, the money's been growing tax-free, but you've been able to have some flexibility and have access to it in an emergency. Now, of course, I'm assuming you have your own cash emergency fund, because you don't want to be investing money if you're going to need to call upon it within the next 5 years. But that is an option for people. So it's never an all or nothing. I think in money, we do get a little bit caught up on this all or nothing idea. So you can do a bit of both, or do something that gives you a bit more flexibility. Just jumping back a stage to the investment environment, I got asked a question, or one question was asked on the panel, and I didn't get to answer it, in fact. And it was about somebody who said, my pension's crashed, what should I do? And it goes back to the idea that if you're investing for the long term and you are happy with the level of risk you're taking, this is the 1 in 100 year style event that's going on. So you have picked your portfolio presumably because it matches your risk appetite and your long-term goals. Now, nothing's changed because on paper you've had these losses that are occurring this year. You've got to think about it, that you could be investing in your pension for the next 30 or 40 years. It is not this downturn you've got to worry about. It's not even the next one. It's probably 1 in 3 or 4 years. This is just the cycle of what's going on. There are people who aren't drawing on their pension yet, who were investing before the dot-com bubble burst, because that was only 20-something years ago. So you've got to realise that we don't want to get bogged down in the ups and downs too much. As long as you've got a plan, you're paying in, and you've picked your investments according to what your plan is, then you should stick to that plan, because this is part of the natural ups and downs of investing. The danger is if you panic, you just start to crystallize losses within a portfolio. So I didn't get a chance to answer that at the event. So if you were at the event, hopefully that's helped you. The other thing I want to quickly talk about is people always focus on younger people when they're talking about pensions. And there are a whole wave of people who are perhaps in their 40s and 50s in particular, who haven't contributed enough to their pension. And they suddenly realise, because that's the time when a lot of people start realising or thinking about pensions, because it's not too far away when they want to retire. And they look at the money they've got and think, I haven't got a pension. And when people talk about, yep, you need to put as much as you can into a pension, and they're told about the power of compounding and how amazing it is, which is definitely true. But of course, when your time frame is very small, then the power of compounding doesn't work as well. It's that analogy I mentioned before. You're on a hill and you're rolling the snowball down. The higher up the hill you are, so the younger you are, the more snow it's going to collect on the way down to the hill. So you don't have to push as hard, are you, putting as much in at the start. And you, over time, the compounding means you end up with a big snowball pretty much no matter what. The problem is if you're older, you're starting at the bottom of the hill. So you're going to have to start with a really big snowball to end up with something that's similar to someone who started a long time ago. That's just mathematics. Now, I want to give hope to people. We always think about retirement in that conventional way, that you either lucky enough to have worked in a career, that you maybe had a final salary scheme. Those days are gone for most people. But then obviously people were contributing to a pension. That isn't the reality for a lot of people because the messaging just wasn't there like it is now. So what do those people do? My view is to turn this all on its head, right? And we talked about this at the live event. Happiness is a mixture of purpose and pleasure. There's a book that I talked about called Happiness by Design, and I'll put a link to it in the show notes. And it's a bit of a heavy book, but it's got a very simple concept to it, which is basically happiness is a mixture of purpose and pleasure. That means that having fun, enjoying yourself, but also getting that feedback of something that you've achieved worthwhile. So think about it. If you stayed on a desert island, it'd be idyllic at first, then not too long after that, you'd get fed up because you get bored. Equally, when you're all purpose and you're in life and you might have a job that you love and you think it defines you and you get that feedback, you eventually become unhappy because you're working too hard, you've got no pleasure. So taking that idea, retirement can be like that too. So just because you might still do a bit of work, that might help you get some kind of purpose. But not only that, you might do something that you just enjoy. So you might be looking at your retirement and think, right, to get a £5,000 a year income based on gilt yields at the moment, and generally what you might get from drawdown reasonably be able to take out, you might get £5,000 a year from £100,000 pot of pension. So you're sitting there thinking, I'm going to have to save up £100,000 in the next few years just to get £5,000. How about this? How about instead in your 50s, at the point when you've got a massive network of people probably you've known throughout your career, you've got lots of experience, and you've probably got things that you know that you enjoy in life because you've done lots of different things. How about you take a hobby or something you're good at and you see if you can generate a few £100 a month from it on the side. And that could be just by making something, selling something. Money to the Masses started out of a principle of just trying to help people, and it became a business. Trying to do that, say give yourself 5 years to do that. So you're only making maybe a few pounds a month, and it will soon build up. If you made £400 a month from whatever it is, your passion, your hobby, the thing you really love, and trust me, you get sucked into things that you love. Money to the Masses, again, like I said, was built from doing that. Then £400 a month works out to be just under £5,000 a year. So all I've told you to do is do something you love and generate a small amount of income from it. And trust me, it's far easier than you think to generate that level of income. You haven't had to save up £100,000 to do that. And so you can supplement what pension you have by maybe using that approach. So rather than thinking negatively and thinking it's all over, think positively about what you can contribute, and actually don't beat yourself up about the fact you didn't put money in your pension earlier, but you can do something about it and start putting those wheels in motion. So it was an important message from that event I wanted to share with people on the podcast. And one final note, when you think about your retirement and you want to know how much should you contribute or how much income will you get from your pension pot and all those things, and trying to pull those levers with regard to pension, don't forget Money to Masses has a brilliant calculator. So the second calculator I've mentioned in this episode, a retirement calculator, which we will put a link to in the show notes and on the article of this episode. And you can find that calculator by searching pension calculator on the Money to the Masses website, and it will do everything, that calculator, for you, including what would happen if you deferred retirement.
Okay, so let's move on to the last piece of the podcast then. And Damien, you gave a bit of a teaser earlier. We've got a guest coming on to talk about something that you've been doing recently to help in terms of cutting down your food bills. So who have we got coming on?
Yes, so it's probably the most important person in the history of Money to the Masses. Actually, it's my wife. So we've almost done 400 episodes and she's never appeared on it. She's never appeared anywhere to do with Money to the Masses. And I say that she's the most important person because if it wasn't for my wife, when I quit my day job, she sort of agreed to the whole idea and was well on board with it and said, look, you've got to do this. And so I did. And then the rest is history. That was, nearly 8 years ago. So welcome to the show. Right, this has got to be the honest answer to a question. Have you ever listened to an episode of the podcast?
Yes.
Oh, well, I'm impressed. I didn't realise you'd ever listened to an episode of the podcast, but that is impressive. I thought you never had done. Right, so we're going to do on the podcast a piece about food because we've kind of come a bit obsessed with a particular app.
Well, I have.
Well, you have. So in episode 372 of this show, we did a piece about apps to cut your food bill. And that was back in June. So recently I started looking at that because, like everybody, cost of living, trying to save money on a food bill. And I decided to use it. And to give a quick summary of what it does, Too Good To Go is an app where you can pay typically £4 and you will select a shop that's nearby that takes part in the service, and they provide something called a magic bag, which is effectively a bag of food that's about to go out of date. So you can think of things like stuff in the fridges or freezers, it could be sandwiches, and they put together a package that is random. You don't know what's going to be in there, so it's a bit potluck, and you go there, pay via the app, you collect your bag, and then you go home and see what's in it. So a simple way of thinking about this is a bit like going to the supermarket and getting the yellow sticker stuff at the end of the day. This is a way of doing it via an app, so you don't have to go and rifle through things. You just get that potluck in one bag. But of course, the stuff usually is worth around about £12. So that's what the app says. But I started to do this and I started talking to you about it, didn't I? Yeah. And then our kind of obsession started from there. So I wanted to talk about it on the podcast and give tips, because how much do you reckon we saved on our shopping bill in the last month using it?
£100 maybe?
Yeah, about £100.
I probably did about 5 magic bags perhaps in that month. Yeah. And mostly you get about £20 worth of food, I'd say, when you get it. It varies depending on where you go. But if you're only paying £4, that's quite a big saving, isn't it?
Yeah, and so you've got to picture this, right? So we were getting the food and we're taking pictures in the living room because I was going to do a blog post or something about this or something on socials. And of course, I've just got all these pictures, which we'll put a link to actually. Maybe we'll share them on the website below this episode. So I thought what we'd do, I've given everybody the sort of basic premise of it, but how do you use it at home? How do we do it?
Well, first of all, I've tried lots of different places. We're lucky where we live that, we're in a London suburb. We're within a mile of lots and lots of different restaurants, supermarkets. There's a lot of choice. So I just downloaded the app and then had a look at what was in my local area. And I've tried quite a few out. And the one that I find myself going to regularly is a cost cutter that's very close to our house. And I tend to go when we're a bit low on food, go and see what I get in my magic bag and then freeze some of it. That's the key really, is that you probably want to do it when you have room in your freezer, because everything you pick up has a best before date of the day that you go and collect it, and often it's in the evening that you collect it. So I would often do it so that Damien and I perhaps haven't eaten yet, so we can see what's in the bag. Hopefully there'll be something that we actually want to eat for our dinner that night, and then keep some for the next day, because in my mind, day out of date is probably okay for most things.
Just why I feel sick after. No, I'm only joking. It's all good.
And then I will freeze what I can basically for future dates. So you might get, lots of meat or something which you're never going to eat in one day. So I freeze it, make sure I've got room in my freezer before I go, and then we use it as time goes by.
So one thing I wanted to point out, because I have seen criticisms online, people saying, why don't they just give it to the food banks and stuff like that? The issue is that the food that they give on this app is typically stuff that has to be chilled or frozen. And you can't give that to a food bank because they don't have the storage. So this stuff is basically going to go into some kind of compactor or be thrown away. So it's something that you're buying and it reduces waste. When you use the app, it tells you how much carbon dioxide you've saved and how you've helped the environment. So there's that extra positive, not just saving money. Now, we've been doing this for a while, and like you said, we've saved some money. But some of the other tips that I think that we've worked out is I did one and it was co-op and it was pretty dire. I mean, I have to say, you just got sandwiches and sausage rolls and that kind of thing, and not so much of the actual food stuff. But I think it's safe to say, if you shop around, look at the reviews, because they do review the different places on the app, and you try different ones, then you find stores that do really good stuff. And also, we worked out that if you go somewhere where it's actually surrounded by quite affluent housing, and it doesn't sell sandwiches, for example, it doesn't sell to businesses, then the stuff you get is better. I mean, we had one, I reckon we must have got about 30 quid worth of meat in it, didn't we, and fish?
Yeah, we did, yeah. So the other tip, and maybe it's a coincidence, I need to try this again, is that on a Sunday, the shops close a little bit earlier, and that was the big one that we got, wasn't it? We went on a Sunday and we were really excited when we got our bag home, because we had lots and lots of things. And like you say, we probably got about £30 worth of stuff for £4.
I think people can tell the excitement in your voice, because you've become slightly addicted to this. I mean, I was addicted to Pokemon, right, on my phone, and I'd just sort of be getting home and then suddenly be going, oh, I've got a magic bag you need to pick up at 8:15. And we'd go along there. But I have to say, I think it's good because it is money that you're saving, but the stuff we're getting is only stuff we'd probably buy anyway. But But, I mean, there are drawbacks.
Yeah, I mean, I think one of the keys is that if you're a family of fussy eaters, then it probably wouldn't work. We're generally quite, maybe not you, but I'm quite open to eating most things, and so is our eldest daughter. So, I think if you're flexible with what you eat and see what you get, and then you can go to the supermarket the next day to build around what you've already had, then that will work. Another thing is that people can put reviews on there. So you can actually see the reviews that have been given to each place and, then think, oh, that one sounds good. Everyone likes that one. So let's try that one out. And some are really popular and they literally sell out within, they often will only have 5 bags, for example, each day. So you've got to be in there quick. So, for example, the M&S BP garage near us obviously sells M&S food, and that's really popular. It has a really high rating, and I know that our local one comes on at 10:16 every evening. So if you want it, you've basically got to set an alarm for 10:15 because it's sold out within 5 minutes.
And another tip on that, you said that they've got a number of bags. If you turn up right at the point when those bags are available, so you drive down and you get there straight away, sometimes you can get a pick of the bags, and while you can't necessarily see exactly what's in there, you can certainly get an idea. It's a bit like a mystery bag. You think that one might have a joint of meat in there. I'll pick that one. Sometimes you're just handed one. It's the luck of the draw. But yeah, if you get there early, at least you give yourself the opportunity of picking the biggest bag.
Yeah.
Well, a bit of a confession, because I've actually done that. I went to one and it was a trolley and they had different bags, and they said, oh, you pick one of those. And I'm not going to just randomly pick one. So I went and picked the one that had the best bits of meat and stuff in it. And I remember coming into the office and someone said, couldn't you just change stuff around in the bags? And I'm like, no, not really, because that wouldn't be very fair, would it? But sometimes you can pick them, and there's nothing wrong with doing that.
So I was just going to say as well, we keep talking about meats, but there is an option on there where you can select that you're a vegetarian. So obviously, it's not only for meat lovers. I actually don't eat meat myself, but others in the family do. So it works for us. But you can select that you are vegetarian as well. So it doesn't exclude veggies.
Yeah, and you do sometimes get random stuff. We once got 3 packs of butter in one bag that were going out of date. But of course, butter, you can just use it almost forever. But I would say it's really good. The reason we done it on the podcast, it's not just because I wanted to get you on the podcast for the first time in 400 episodes. It's because it is something that we're generally doing, and it is so useful. It isn't based upon where you live. You can do it anywhere, because if you work somewhere and you've got some good places around there that use the Too Good To Go app, then as long as you can store the stuff in a fridge or something at work, you could do it in your lunchtime, go and get the bag if they're available, because they do dictate the time in which you can pick them up. But then you could perhaps use that and then take it home.
I was also going to say that we've talked about supermarkets and food for, cooking at home or preparing at home, but it's not just supermarkets. There's bakeries, there are places like Krispy Kreme we've got here. Up in London, all that, I think most of the upper crust do it. So when I went up to London the other day, I sort of, everywhere I go now, I have a little look in the local area and see what there is. But obviously, if you're in a big city, there are loads and loads of options. Starbucks do it, Pret, Greggs do it. All these sorts of places do it.
Well, you did a really good one time where we went to Lola's Cupcakes and we got the kids cupcakes for like a movie night. So it just shows you they're expensive cakes and they might do it. So the message is, do try it if you want to try and save money on your food bill. We've had a huge success, which is why we put it on the podcast. It doesn't work for everyone, does it, Andy? Because you didn't enjoy it at all because you've done it previously.
Yeah, I live quite rural, so I only have a choice of maybe 3 or 4, and it's a bit of a drive out. And when it's raining and cold, you don't really want to get out of the house. When you end up coming back with about 7 sandwiches, which all go off that day, sometimes it can be a little bit deflating. So yeah, download the app, give it a go. It works sometimes. It's the potluck. It's a bit like Christmas for me. I love a surprise.
So I'd just like to thank my wife for coming on the podcast. It's the first time in nearly 400 episodes. I don't know when she'll agree to come on again, but maybe we'll have a new section on saving on food and stuff like that we can bring in regularly. A bit like Jordan, bring him on every now and then.
Right, so that's us done for this week's podcast. If you want to get in touch with Damien, you can do so in the usual way. It's Damien at moneytothemasses.com. Don't forget to check out our Facebook group if you haven't. It's a great way to interact with the show and other like-minded listeners. Is facebook.com/groups/money to the masses. And we've mentioned it again at the end of the podcast. Should be doing it at the start, Damien. Please do review the podcast if you can in the usual way. We've been on Spotify this week and seen that we've got over 50 glowing reviews. I think we're averaging 4.9. So if you're on Spotify, great, give us a review on there. But anywhere else you can, we'll read it out on the podcast and maybe you'll win a Money to the Masses mug. So that's it. We're done. Until next time.
Until next time.